Well, let's get across the market open. Now, Marcus Padley joining us from Marcus today. Marcus, welcome back to you. Let's start on Wall Street. Record after record. That's sounding like a broken record, isn't it? Mind you, do you feel as though momentum is slowing there?
Well, we've got a tale of two markets, Andrew. We've got technology and the rest, haven't we? And it is amazingly, with war bubbling in the background, and I say that because I think there's a good chance this is going to deteriorate again. But with war bubbling in the background, even if war breaks out, I think everyone's seeing tech as a safe haven in a difficult market. It's also got the most growth, and it is the most obvious, effectively safe theme in the market at the moment. And we work off principles, and one of our principles is that don't let what the share price has done in the past dictate what you do with the share price now. In other words, just because a stock's gone parabolic doesn't mean that you don't buy it, and just because a stock's falling doesn't mean that you buy it. And you just have to ignore the charts for the moment and assess on a balance of probabilities what's going to happen next. And on a balance of probabilities, assuming there's no sudden military recurrence and a bond market Armageddon, on the current balance of probabilities, tech is the place to be, and tech is where everybody's going. And the rest of the market just pales into boredom by comparison. So we're fully loaded on tech until it goes wrong.
What about when you say fully loaded on tech? Is that purely US stocks, or what do you see? Are you seeing opportunity here locally? Because certainly the local tech stocks have turned.
They have just in a couple of days, you've seen stocks like Pro Medicus and Xero start to lift off the bottom. And the way we play that, we can only invest in Australian listed ETFs. So it's a pretty ugly way to play it, but ATech is the Australian all technology sector, which of course is the biggest holding is Computershare, which is a bit silly because it's not a tech stock, but it does embody, but that sort of dulls the volatility, which is quite good. But it does embody our growth stocks, which includes software stocks like Xero, WiseTech. And in the last couple of days, you have seen a fairly significant lift in sentiment towards US software stocks. Not so much this morning, it's got to be said, but that has seen the ATech chart sort of break up a little bit. And whilst we don't work off charts, it is telling you that sentiment's returning, and that's important, and that this is one tech sector or one tech ETF that is on its lows, not on its highs. So we've had a bit of a go at that because we see a relatively little downside from here in that, and potentially a significant sentiment recovery. So we bought ATech. Otherwise, we're playing it through the S&P 500, the Nasdaq, FANG, and that'll sort of do us. We're risk conscious, so we don't need to be getting super clever by going into specific tech areas too hard. I know there are a lot of ETFs around, and the ETF issuers are very good at creating ETFs over all sorts of areas, but you'll find the big stocks are still dominating every tech ETF. So we can play a less volatile performance in tech through the bigger index-related ETFs, and that's what we're doing. Plus a couple of other ETFs that are tech-related.
Marcus, locally, what do you make of the two largest sectors? The banks, certainly sensitive to what we've seen out of the budget, and resources, very sensitive to what's going on in the Middle East.
Well, the banks, this we're always a buyer of the banks. We would only hold them for income. We hold them in an income portfolio. You don't generally trade the banks. You hold them long. As an Australian retiree, you hold them in the long term for income. They're some of the best income stocks in the world, as you've heard me profess a number of times. And you look for moments of weakness to buy them. The budget has clearly dented attitudes towards the housing market, the outlook for the housing market. And the way to play the stock market is not to follow the herd into a hole of despair about the housing market and the banks. The way to make money is to spot when the herd has got too pessimistic or too optimistic, when the sector's in a sentiment hole or a sentiment bubble. And we're clearly moving more into a hole than a bubble, away from that bubble that we've had. And we would be looking to buy the banks at some point. The auction clearance rates are probably going to be the worst the week after the budget, not a year after the budget. So we're in a bit of a sentiment hole. You're never in a rush to buy the banks. I would let this wash through. Maybe we'll get an even better buying opportunity. But the banks are a buy at some point. And as far as the resource is concerned, we're now playing resources. I mean, you can buy things like ETFs like QRE and OZR, but you'll find that they encapsulate all the resources, and the resources sector's got different bits. And one of them is energy, which is going to do diametrically the opposite of the rest of the resources come a war or peace decision. And yet they're all folded in together. So the cleaner way to play it, we find, is through wire. As you know, BHP is dislocated from the iron ore price towards the end of last year and started to follow the copper price, understandably as well. And wire gives you a copper exposure, which of course includes BHP. And so we would play resources through wire. We do hold wire at the moment. There's a long-term story about copper demand, obviously, and data centers, although that quite honestly makes a marginal difference to where copper is going in the world, but it's a good sentimental story. And so we're in wire at the moment, which again is a way to play resources. It's working for us at the moment. We'll run it as long as it runs.
And overall, how's your performance at the moment, Marcus?
You're giving me an opportunity to advertise myself there, Andrew. We are, I tell you, if you read my weekend newsletter, we may just have worked out how to do it because we don't have the handcuffs on that traditional fund managers have, because we can go to cash. And the whole of my super is in my fund. Our fund's up now to 155 million from zero last February. And it's up 36%. And we have done that by avoiding risk and playing the best themes. So we've been in tech, out of the market, in tech, out of the market, and we're in tech and wire and a few others at the moment. So our ability to go to cash, which is in our mandate, is just something a big fund manager can't do. So we're not marketing hard. We're just going to let the results speak for themselves. At some point, we're going to be running a lot of money, I think, if we keep this up. And we've every confidence that we have nailed a process which is going to make a lot of Australian retirees extremely happy, as it has done already.